Prasanna, hi, great to have you on the show. Just the case that we're making right now, you heard us hopefully wanted to understand whether these rationale are correct enough for a higher allocation to debt as an asset class.
Yeah, so I was listening to what Nikunj was saying, and I must say that I think he said all the right things. As far as asset allocation is concerned, it's actually a question which every individual will have to answer. So there is no one, a broad solution for everyone. But at the same time, I have to say that with interest rates looking close to peaking out, of course, Nikunj made a call that it is actually peaked out. Of course, we have always there is a lot of uncertainty in the way inflation and data comes through. So you never know till it actually peaks out. So possibly it's already peaked out at around 760 or 760 on the 10-year that he was talking about. We are at 720.25. More importantly, I think we are closer towards the peak rate hike as far as the US Fed is concerned. And with the potential of maybe them going all the way only up to 475 to 5, in which case you can argue that RBI's peak rate would be in the region of 635 to 650. Then it does make a sense for people to seriously look at debt as an alternative asset class. Over the last 2 years, especially post COVID, I think, or rather in the last 1 year, I must say that because of rising inflation, interest rates had gone up so much. But before that, the interest rates had dropped so much that the average investor on the street possibly thought that the opportunity cost of not investing in debt and instead investing in equity was not very high. So let me increase my equity asset allocation. So it's quite possible that asset allocation in the last 2 years might have gone in favor of equities. No, I think there is a sense for people to look at their own risk appetite, look at their own asset allocation strategy, and then maybe shift a little bit towards debt.
Here, why did you say Lakshmi Iyer?
Okay, so you're making a case that this could be a time to increase debt when we look at the asset class allocations. But Prasanna, the other point to ask is that what should be the equity to debt ratio in portfolios at the moment?
So is that to me?
Yes, to you.
No, so that's what I was saying. I don't think you can make one portfolio allocation percentage as a formula for all individuals. I mean, every individual has his own risk appetite, right? And he has to decide how much of uncertainty and how much of safety he wants in his portfolio, and that will determine how much of asset allocation he actually puts on the debt side and the equity side. And also remember that young people who just got into the workforce will obviously have a much higher risk appetite and can afford to put a bigger proportion of their savings into equities. But as time goes by, you probably have to look at post-retirement returns, which could in returns might want to prefer fixed returns. So I think there is no one solution. You need to look at your own individual asset allocation to decide on that. But the overall concept of debt at around 7 to 7.5% returns, depending on whichever way you look at it, is definitely much more attractive today than what it was say a couple of years ago when you were looking at 4 to 5% as the average return. So depending upon your risk appetite, you choose what kind of instruments you want to be in and what proportion of debt you want to be in.
Fair point. And with that, I'd like to also introduce Lakshmi Iyer, the CEO of Kotak Investment Advisors, who's also live with us to talk today to us about whether debt as an asset class is becoming more attractive. Lakshmi, let's begin with your views on this. The fact is, equity valuations going up. The pace of rate hikes likely to slow down. We've got that signal from the FOMC. India maybe is going to mirror the same later on this week as well. Are you folks looking at debt in a far more attractive way, and are adjustments also therefore being made in portfolios?
Yeah, hi, good morning. I think, bulk of your queries already had the solutions also to the investors and what the mood is right now. If you look at it from a valuation perspective, one does not deny that there could be elbow room for markets to edge up, but certainly at an elevated level, caution is building up. Secondly, if you look at the landscape of fixed income across categories, from say liquid to ultra short term to the long duration funds, how have the returns panned out in the last 12 months? It's been ballpark in the region of say 3.5%, 4% for 12 months, and probably around 4.5% range for 24 to 36 months. Maybe a tad higher for the 3-year bucket. But the fact is that the high end front loading of the rate hikes has reflected in the mark to market losses. And that's the reason the fixed income returns have looked muted. Incrementally from the current levels, given that the portfolio yields are looking attractive, it does, and bulk of the investors, if you see, by and large, I'm talking about the domestic investors, by and large seem to be under allocated or seems like they are very much at the short end of the yield curve. So therefore, a case for adding allocations at the current juncture and increasing the duration also makes a lot of sense.
Lakshmi, today looks like interest rates are nearing a peak, commodity prices are down. Historically, when we've had these kind of an instances, what happens to the projected debt returns both in the corporate debt market and in the government debt market for next 12 to 18 months? Could they be nearing double digit, or that's slightly outlandish?
Double-digit return, Nikunj, right now, maybe I'm a bit myopic. I'm not able to envisage that. Usually, a rule of the thumb, and again, it's not cast in stone, is that over 2 to 3 years, investors tend to realize the gross yield of these portfolios. So if you look at the fixed income landscape of gross yields available today, it is in the ballpark region of 6 to about 7.5%. 6% is for closer to say the 90 to 100-day bucket, and 7.5% is closer to the 3 to 6 year duration bucket. So if one actually allocates say between now for the next 12 to 24 or 36 months, assuming that there were to be at least one favorable rate cycle, if not two, one is a fair assumption to take, and we actually start seeing the benchmark repo rate sliding down with a lag of 12 months, it's not impossible to expect high single-digit returns from fixed income over the next 12 to 18 months. So I think that's what one needs to keep in mind. And markets have this ability, to your earlier point, to discount some of these events way ahead of its happening. And that's exactly what we are seeing in the bond markets right now.
Prasanna, what are the chances that 2023 and beyond we could be in for a hard landing, a recession, and we could actually see a decline in, where central bankers may be forced not only to acknowledge that the inflation is behind them, they could be in fact considering a rate cut. I mean, there is a thought that Fed may actually start cutting rates by end of 2023. If that scenario plays out globally, what it means for debt market investors?
So, Nikunj, I presume that you talked about the global central banks when you talk, and global economy when you talked about recessionary. I don't think India has that to fear at all. I think we will still do well, and of course growth will slow down, but I think we'll do much better than most of the large economies. But coming to a point of hard landing versus soft landing in the global scenario, so I think at the pace at which the Fed was tightening financial conditions, and even the European central banks and other central banks were doing it, at one point of time, maybe a month ago or so, there was some serious thought of is this kind of a rate hike going to lead to some kind of hard landing and much more increase in job losses and all that, because all of these happen with a lag, right? And Fed was hiking rates with today's inflation in sight rather than expected inflation. So they were trying to regain the credibility and so on and so forth. But I think over the last 2 weeks or so, if you have seen the Fed minutes as well as the kind of speech the Fed chairman has spoken about, it seems that they're definitely kind of willing to give that lag effect a chance, and also say that, I mean, acknowledge the fact that inflation has started coming down in the West on an incremental month-on-month basis, though the Y-on-Y number is still a very high number. And hence, seems to be a cognizance of the fact that they need to be a little bit more responsible when they hike rates and allow it to flow through the economy and see the effects of it before they continue with it. So my feeling is that what they are saying over the last 1 month or so actually reduces the chances of a interest rate driven hard landing that was a fear a little while ago. So I'm willing to, bet a much high probability of the fact that there will be a slowdown and the Fed will not overhike. And yes, in a 12 to 24 month period, there are possibilities of rate cuts which can happen, but that will be dependent upon how quickly inflation slows down and how quickly labor data comes in their favor. We have to have a close watch. It is very, very early to speculate on those things right now.
Right, Lakshmi, Prasanna, great to have you both on the show and join in the discussion today.